Okay, looking at yesterday's price action, we opened within yesterday's trading range. It increases the chances that today will be a trading range, even though we were able to get a pretty decent rally for about half the day. So the first hour or two went pretty sideways here, which is not surprising considering where we opened. And look at what this open did. It tested yesterday's low and also broke out above and to test yesterday's high. So when you open within yesterday's range like this, you can expect the market wants to try to test at least one of the important levels. Often it tries to do both. So we made several attempts to go lower here. So 1, 2, 3, 4, 5, all of which that failed. And then the market decided we've sufficiently tested this area. Then it races up to test the close of yesterday and to test the high of the previous day. And you can see initially there were quite a few sellers around this level of yesterday's high, and that caused the market to pull back some there. So typically, a rule that I have is when I see a trading range and there are large bars within the trading range. So you can see these bars, a lot of these aren't really, the bars themselves aren't really trading range bars because, like, look at bar 1, it opened on its low and it closed near its high. Bar 2 opened near its high and closed near its low. So it's mostly, the bars are mostly body. And, you know, it's different from the little doji bars like we would have here. So when I'm seeing lots of bars that have a large body, and they're large bars, especially relative to the previous day's price action, I would call that a large bar trading range. So that's what I would call this here, large bar trading range. And when I see a large bar trading range, I typically avoid trading because it's so easy to get caught up in a trading range like this, where the range itself isn't too large, but the bars within the range are large. So that means your profit is small, but let's say if you're buying somewhere in here, then your risk is fairly far away because the bars are large. So it really doesn't make too much sense. So it can be a difficult place to trade. So I typically avoid trying to trade something like this, especially on the open. What some traders will do is they will try to look for swing trades on the open. Because yes, this is a large bar trading range, but it'll probably at least double the size of this range in either direction. So for example, like this, we have the high of the range and the low of the range, and there's a good chance it's going to double. In which direction? Well, it's uncertain, but it'll probably double in either direction, in one of the directions. So maybe it'll come down here, or maybe it'll come back up here to the highs up here. So what they'll do is they'll try to look for a swing trade. So possible double bottom on the open here, and they'll buy above there, hoping to double this early range and try to get up to the highs of yesterday. So then maybe they would buy here, or maybe they would buy maybe above this high here. So a couple buy opportunities for swing trades. So maybe they put their stop below the bar and they try to go for 2 or 3 or 5 times their risk. There's also going to be sellers in this. So see the move up to the moving average, failed at the moving average, possibly swing traders selling below there or below here. So yes, they will lose 1 or 2 or 3 times. When they win, they're going to get a buy like this, and they're going to have a potentially a huge day out of it. So that's one way that people trade. And another thing to consider is that you often won't take your full loss on a trade. So for example, if you buy above this bull bar here, this double bottom below yesterday's low, let's say you buy here and you're going for a swing trade and trying to get somewhere up here. Well, after you buy here, then you get a follow through bar and then another bull bar, close it above the moving average, you're probably going to move your stop up some. And at that point, you wouldn't take a full loss. And then if you get this bear bar down like this, you'll probably get out below that bear bar. So you would end up with a small 2 or 3 tick profit instead of taking a larger, like 10-point loss down here. So not all of your trades are going to end up as the full loss. Some of them will end up as a full loss, some will end up as a basically break even, and then some will end up as a large win like this. So typically when I see the open like this, I avoid it, but that's what some people, that's how they can trade it. And right, if they take the right trades and manage it correctly, then they can definitely make money doing that strategy. The first trade I will mark is going to be right here. And what's going on with this, why is buying here different from selling here? Well, buying here, I feel like if we're in a larger range, like we are we're really low within yesterday's range. So if I'm buying here, I'm relatively low in that range. Compared to if I'm selling here, I'm selling relatively low in the range. I'm basically at the lows of what the possible range that we're in. So for that reason, that's not as good of a short. Also, looking at yesterday's low, let me draw a horizontal line in. We can see all of the failed attempts to go lower. Like I pointed out earlier, we have 5 or 6 attempts here by the bears, and they're all failing. So because of that, once I see all those failed attempts, and then I get a bull bar, and then a good follow-through bar here, then after 2 bars like that, closing on their highs, that's probably good for a swing or a scalp. I think you can probably scalp out and get your 5 points to get out around this high. And look at your targets above. You have the close of yesterday, you have the high of yesterday, farther above. So that's a reasonable trade. And that's different from here because you're basically selling right into the lows. You're trying to sell right into this area that we've already failed at several times. And you're selling relatively low in this larger trading range that we've been in. So then you get a pretty decent rally. You get 6 or 7 bars up without a pullback below the prior low. Probably buyers below this bullish bar here. And that's what we got. Okay, so decent rally up. Probably going to get some sort of second leg up after this. And there's usually buyers after a low once we've had 6 or 7 bars without going below the prior low. So this is the first time in 6 or 7 bars. So probably buyers below that. It's a bad sell signal, right? Because this is a bull body. So probably not too many people selling below it. Also, possibly we're still in a trading range, right? So if we're looking at this, we're probably going to get a little bit more up. Or if we're in a trading range, even if it comes down here, we'd probably be able to buy more and get out. So in either situation, this should be reasonable to buy. And of course, you're hoping that it'll just get your 5 points quickly like it did here. It's better to avoid having to actually wait and have it come all the way down here. So I'd probably manage it earlier, but with the idea being that we probably would be able to buy lower later, that improves the chances that this, as a buy in general, would be able to work out. So if I'm buying here, I'm going to be trading small, and maybe I would put my stop here below the start of this leg here. Probably wouldn't let that get hit, and I'd probably exit before then. Or some people might put their stop way down here, and like I said, they would come down to the bottom of the range and then buy more and then exit at their midpoint. But that's when you can kind of get into trouble if you don't manage it right. So for beginners, don't put your stop down here. I would rather try to put it closer. And for that reason, that's why limit order scalping really is not for beginners, because there's some challenging questions on stop placement and on management, and that if you're starting out, you're gonna probably mess that up. So anything you can do to reduce the amount of decisions you have to make or reduce any complex management, then that's going to make you better off. So if you're starting out, I would avoid taking that, because I remember when, I don't know, like 10 years ago, 8 years ago, when I was taking trades like this, I would say, well, it should be working out, but I'm messing it up. And it takes some practice and experience to be able to not mess this up, even though it is a good trade. What about selling above this bar here? Now we've had 6 bars down without going above the prior bar. So what about selling here? We've had this little bear leg down. We might get a second leg. So what about selling above that? Well, I would rather avoid that. What's different about this buy here and this sell is that this buy here, we're starting to trend up now. We're above the moving average. The bulls have been making money. Here, this is more like just a pullback in what is a larger bull trend. And you'd also be selling pretty close to the moving average. So I'd rather not be selling into the moving average in a bull trend. This is more of the buy zone. So for that reason, this would not be a good sell above that. A couple buys that I wanted to mark. I'm going to put one, we'll talk about this one. And if you look to the left, we can see yesterday's high is right here. Okay, so at this point, what have we done? It acted as resistance here, pulled back. It broke above yesterday's high, pulled back, and this is basically testing that level. Now we're above it. Now we get a follow-through bar. Right, so there's a first bull bar, and then you get a follow-through bar after that. So I think that's reasonable to buy above there. Now we've had a breakout test of this level. You could also look at it as there being some kind of gap in here, a body gap. So this close, market broke out above that, and then it did not come back and test this highest bull close. So the tails here overlap, this tail and this tail, but the close of this bar and the close of this bear bar did not touch. So this is a body gap. So not only do we have a body gap, but we have a breakout test of this piece of support and resistance, and now we're getting above that. So I like the idea of buying above there for a swing trade or a scalp, but in my mind I'm really marking this as more of a scalp. So I'm buying here, putting my stop below the bar, and I'm trying to get probably like 5 points out of it. And in the same way, pretty much for the same reasons, buying above here. Right, we have this support and resistance level. We're double bottoming at that level. You're getting a bull bar, then a follow through bar. So now we have 2 bull bars. Probably any bears that were shorting through here, we're probably going to exit. So when I was talking about bears, like what about selling above this bar here? Well, anyone that did sell, and now they get this big bull bar and then a follow through bar, they're concerned. They're probably going to exit above here. They're going to manage their trade and exit. So if people are exiting their shorts here, I want to be getting long. And another thing to point out is we have a gap right here. You can see the high of this bear bar, then you get a breakout and a pullback. The low of this bar does not come back and touch that tail. And the reason gaps are important is because the sellers above this bar were not able to get back to their first entry point. So they sold, maybe they sold higher, but they did not come back to let them out at their first entry, which means they're trapped, and which means they're probably going to exit here. So that's the reason why I want to be buying here. So as the day continues to move on, we want to look at where we are in the market cycle. So here was a breakout. Breakouts lead to channels. So breakout, channel, and channels weaken into trading ranges. And then here we get the trading range for the rest of the day. So if we had a bullish day and we're probably low in a trading range, then for that reason I'm interested in buying here. So I'd be buying below this previous low, and probably low in what will be a larger trading range, and that's what ends up happening here. This is a little bit late in the day for me to be doing a limit order scalp, especially if I intend on scaling in, because if you buy here and it keeps on going down and then you buy more, well, that takes time. and there's not that much time left in the day. So you have to, if you're going to be scaling in, you need to make sure you have enough time left in the day for that to be able to work out. In this case, you didn't need to do any scaling in. You could just buy here and get your 5 points or 10 points, whatever you're going for. But if you are planning on scaling in, you need to make sure you can have the time to be able to manage it and exit it before the end of the day. So around 2:30 Eastern time is when I stop trying to do that kind of trade. But this is probably still early enough. And I wasn't planning on scaling in here. It was more of a buy here, put my stop 10 points down, and then just try to get a 5-point scalp. So I think that was reasonable to do. And after that, there really wasn't any other trades that I liked after that. Before I go, I wanted to talk about the daily chart, and I want to bring up a point about gaps. So we're going to have a little lesson on how gaps close here. So a gap meaning something like right here, right? We have the high of this bar, and the next day gapped down. So instead of opening at that price, it actually opened way down here, and you can see there's visible space on the chart. Another example is right here. Market closed here. The next day gapped up. It opened at a different price from that close, and visibly there's a space on the chart. So when you see these visible spaces, most of the time those spaces get filled, or even more than most of the time. And I mean, it's very high probability they're going to get filled. However, you run into a situation after you've had a big sell-off like this, and you can go back and look at past sell-offs and look at what happens after them, especially like the COVID crash. What happens is you can get a very sharp rally, and these gaps end up never getting filled, like never ever getting filled. So when the market was selling off, there are gaps like this one, for example, and the market ends up coming back and filling that. So this gap was open until right over here. Or this gap here, this was open until it closed here. So the gaps on the way down always fill, and they will always fill until some futuristic date where the market does not, keep going up in the long term. One day, we'll hit a point where the market, I don't know, 100 years from now or something, where the market won't keep on going up perpetually. But, until that futuristic date happens, then these gaps on the way down will always fill. However, after these sell-offs, the market often rallies pretty strongly, and then during that strong rally, you get these gaps like this. Now, I do think this gap will fill in the future. I'll probably think in the next, even if we keep on going up here, I would probably think the next year or two, market would come back here. I don't know, it might happen in 2 months, or it might happen in 2 years, or more than that, but this will probably get filled. But there's always an increased risk that the gaps on the way up will not get filled, because we do have that bias towards the upside. And especially if we've had a sharp sell-off that leads into a sharp rally, this rally might just keep on going up, and then during the next pullback, I don't know, whatever the next sell-off is in 5 years or 10 years, whatever big sell-off happens, the market might have gone up enough. We might go up to 10,000, and then that next big sell-off, if it goes down 20%, that would only go down to 8,000. So when you're looking at gaps on the way up, what some people will do is they'll sell somewhere up here, betting that that gap will fill, because most gaps do fill. But you have to realize gaps on the way down are different than gaps on the way up. Gaps on the way down will get filled, but gaps on the way up, they might be left, and they might never be filled. So I just wanted to bring that up and kind of give you something to think about as you're thinking about how you trade and how you enter trades and manage them, and it's just kind of an important idea to keep in your head. Okay, thank you guys. Thank you for watching, and I'll see you in the next video.